Welcome back to The Explainer. Today, we're putting a true legacy business through the ultimate valuation gauntlet. Now picture a 112-year-old company. If I say the name Deluxe, your mind probably jumps immediately to one thing: paper checks. For over a century, Deluxe has been the absolute, undisputed king of check printing. But here's where it gets fascinating. They just crossed a massive digital milestone that completely shatters that legacy image. So to figure out if this hidden in plain sight transition makes for a compelling investment, we are putting Deluxe on trial using the rigorous frameworks of three investing legends: Warren Buffett, Peter Lynch, and Benjamin Graham. Okay, let's dive into this and see if there's deep value hiding in this historic transformation.
Here's our roadmap for today. We'll kick things off with a Deluxe company snapshot, then view the business through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some DCF and alternative models, and finally, wrap it all up with our synthesis and final verdict. Let's get right into it.
Section 1, the Deluxe company snapshot. We're looking at a business undergoing a massive, fundamental transformation right under the hood.
So, we're looking at Deluxe Corporation. Ticker symbol DLX. Based on the Q1 2026 data, it's currently trading at $22.94. Now, if you listen to management on their Q1 earnings call, they'll make it very clear. Deluxe is no longer just a print shop, they're aggressively transitioning into a trusted payments and data company. But, talk is cheap, right? We need to look at the actual numbers to see if reality matches the rhetoric.
And wow, look at this. In the first quarter of 2026, Deluxe hit a truly historic turning point. For the first time in over a century of doing business, revenue from their digital payments and data solutions actually surpassed their legacy print business. Payments and data now make up 51% of total revenue, growing at 12.5% year over year. So this isn't just a declining paper business anymore. The digital side has officially taken the wheel.
Moving right along to Section 2, the Warren Buffett lens. Let's look at economic moats and returns.
When the Oracle of Omaha looks at a business, he completely ignores the noise. And surprisingly, Deluxe checks several of his biggest boxes. First up, the economic moat. Deluxe is sitting on a massive data lake, driving thousands of AI-driven marketing campaigns for financial institutions. Plus, they run a deeply entrenched B2B lockbox payment processing service that handles billions of payments. That means incredibly high switching costs. Next, consistent earnings. Q1 2026 marked their 13th consecutive quarter of profitable, comparable, adjusted EBITDA growth. They're also pulling in a very solid return on equity of 15.09%. And finally, Buffett loves an honest management team. Well, Deluxe's leadership promised a 3x net leverage target, and they just delivered it 3 quarters ahead of schedule by paying down over $30 million in debt this quarter alone.
But here's the absolute crucial number for Buffett: owner earnings. Basically, the cash the business generates that can be returned to owners or reinvested. For Deluxe, that number is a massive $200 million. Management reaffirmed their full-year free cash flow guidance right around that $200 million mark. When you match that giant cash engine against a market cap of just over $1 billion, you're looking at a free cash flow yield of nearly 17%. To put that in perspective, a cash engine pumping out that kind of yield, paired with a growing digital moat, that is highly attractive in Buffett's playbook.
Section 3, the Peter Lynch lens. Let's evaluate growth and price.
If legendary Magellan fund manager Peter Lynch were looking at this, he'd likely categorize Deluxe as a classic turnaround, morphing into a stalwart. The legacy print business is for sure in a secular decline, shrinking by mid-single digits. But because they've successfully pivoted toward high-margin B2B payments and data, which are growing in the mid to high single digits, the overall enterprise is stabilizing and really turning around.
Now this is where it gets really interesting. Let's talk about the PEG ratio, a metric Lynch popularized. You take the price-to-earnings ratio and divide it by the earnings growth rate. A PEG of 1.0 is considered fairly valued. Deluxe is sitting at a PEG ratio of just 0.62. Literally, this single metric is screaming that the stock is heavily undervalued relative to its earnings growth potential. Any Lynch-style investor would definitely be paying attention here.
Running through the rest of Lynch's checklist, we got to look at the balance sheet. The debt-to-equity ratio is sitting at 1.98. Lynch usually prefers lower debt, so yeah, this is slightly high. But given that massive recurring cash flow generation we just talked about, it's very manageable, especially since they just hit that leverage target. Now, the Q1 data we have doesn't show specific insider transaction details, so we just have to assume a neutral stance there. But overall, as a strong cash generator trading at a huge discount, it fits his turnaround criteria beautifully.
All right, grab your green eye shades. Section 4, the Benjamin Graham lens. We are calculating that margin of safety.
Deluxe actually breezes right through Graham's rigorous defensive investor checklist. Adequate size? Yup, it's got a $1.05 billion market cap. Earning stability? Check. Positive net income of $35.8 million this quarter. Dividend record? Oh yeah, they pay a regular 30-cent quarterly dividend, giving you a really juicy 5.23% yield. And most importantly for Graham, those valuation multiples are super subdued. A moderate PE of 10.10, well under his max of 15, and a price-to-book ratio of 1.51, hovering right at his preferred limit.
Let's actually run the math on Graham's famous intrinsic value formula. He multiplied 22.5 by the earnings per share and the book value per share, then took the square root of that whole shebang. For Deluxe, we grabbed the derived trailing EPS of $2.27 and the book value per share of $15.24, and we just plug them right into his equation.
And boom, doing the math gives us an intrinsic value of $27.90 per share. With the current trading price sitting at $22.94, this stock offers a Graham-style investor a very comfortable margin of safety of nearly 18%. So for sure, Graham would absolutely touch this stock at today's prices.
Section 5. DCF and Alternative Models. Let's pivot from the historical legends and apply some modern quantitative analysis.
To build a realistic discounted cash flow, or DCF model, we have to rely strictly on the data. We're starting with a base case free cash flow of $200 million, perfectly matching management's guidance. For a discount rate, we're assuming a standard 10% weighted average cost of capital, and this is absolutely key. We are assigning a 0% terminal growth rate. We're being ultra-conservative here to completely account for those ongoing secular headwinds in the legacy print business.
Now, look what happens when we run a sensitivity analysis. Even if we completely punish the company with a negative 2% terminal growth rate and bump that discount rate all the way up to 12%, that $200 million cash engine keeps the fair value incredibly competitive with today's price. Basically, in almost every reasonable scenario, the DCF model is telling us the stock is currently trading at or below its intrinsic fair value.
And just to double-check our work, let's look at an alternative quantitative metric. The enterprise value to EBITDA ratio sits at a remarkably low 5.88x. When you realize that other payments and data companies often trade at multiples double or even triple that number, it really just cements the fact that we are deep, deep in value territory with Deluxe.
Okay, Section 6, Synthesis and Final Verdict. Let's see how all these different lenses actually align.
When we blend those qualitative moats with a hard quantitative math, we see a really clear consensus forming. Buffett's framework triggers a buy thanks to an exceptional free cash flow yield over 15% and a durable data moat. Lynch screams buy based on that deeply undervalued 0.62 PEG ratio. Graham gives it a buy too, with an intrinsic value of $27.90 offering a solid margin of safety. And the DCF models, they point to a strong hold to buy, depending on how conservative you want to be with your growth assumptions.
Now, of course, we have to be objective and weigh the strengths against the risks. The core strengths are fantastic. They successfully crossed that 51% digital mix threshold, they're generating a robust $200 million in free cash flow, and their credit profile is visibly improving. They even snagged an upgrade to B+ by Fitch Ratings because they've been paying down debt. But on the flip side, investors do have to constantly weigh these wins against the undeniable secular decline in legacy paper checks and an elevated debt-to-equity ratio of 1.98 that management will need to keep a close eye on.
So, I'm going to leave you with this final thought. Deluxe is a company that's currently priced like a dying print shop, but it's operating more and more like a highly modern payments and data powerhouse. Given the tremendous free cash flow, hitting their leverage targets early, and that historic shift toward digital revenue, is this the ultimate deep value turnaround play hiding right in plain sight? What do you think? Thank you so much for joining me for this explainer, and as always, keep questioning the numbers.